first of all, we have a total superannuation balance at 1st of July 2025 of 3.5 million. The next line, total superannuation balance at the 1st of July 2026. So a year later, our balance is now $4 million. And in this example, we have concessional contributions of $20,000 and the taxable income of the fund, this is without regard to what we've just been talking about, is $300,000. Now, where I've just got the little hat symbol there, I just want to talk about that for a minute. So the total amount of the superannuation benefits that would become payable if the individual voluntarily caused the interest to cease at that time. That is the definition of the total superannuation balance that is in the tax law. So the person comes along to the trustee and says, right, I want everything that's owed to me. How much is it? And so they're voluntarily asking for that. And then the trustee says it's X dollars, in this case, $4 million, and that's what you're entitled to. Now, one of the things that I've had varying opinions on is the question of whether, in calculating that amount, have they taken into account the tax on the unrealised gains? So it would be, of course, proper to include in that amount, that is, the amount the person is saying, how much am I owed, to include their unrealised gains. That's quite proper. Should you include the tax on the unrealised gains? I would have thought so. But I'm afraid that I've found varying views on this from other accountants. Now, it seems to me that that's an important point, because if we're going to calculate what the total superannuation balance is, and we're not going to include the tax on the unrealised gains, then we're increasing the amount that's in the fund. And we have a sort of double taxation thing that's going on. And I don't know whether anybody else might like to comment on what they would normally do in that situation, but I would have thought that's the case. Now, let me just proceed with the example. So, again, here is our numbers. Now, the calculation is as below. So we have total tax on the right-hand side of $63,112.50. And that's comprised of the 15% normal tax, if you like, and this extra 15% tax. So, first of all, we've got the 15% on the 300,000. That's what we would expect. But now we look at this extra part, and what we're looking at is what they call the earnings. Now, the earnings is the opening balance, the closing balance, less the opening balance, so this total superannuation balance, less, in this case, the contributions, the concessional contributions after tax. So we then have 4 million less 3.5 million at the start, and we subtract from that the concessional contributions, tax affected, and that comes to $483,000. Then we take the proportion of the earnings that are above $3 million. So we say $4 million less $3 million over 4 million, 25%. And so we multiply all of that together and we get $18,112.50. And that's the extra 15% tax that this announcement is about. And so that is an example of how it works. Now, I will say that when this legislation comes out and is finalised, I expect that it will be several pages of complex legislation, because what I've shown you in this slide just looks far too easy for me. And I'm quite sure there are many other things that have to be thought about in the process. But at any rate, that's currently the idea.